Hey everyone, welcome back to the Daily Gold Podcast. Today I'm speaking with my good friend Dave Skarica of AddictedToProfits.net. And if you can tell from my voice, a little bit happier today because the performance of the gold stocks and the precious metals in general looks really, really encouraging. Dave, I mean, look at GDX today, significant daily volume. The market's up 4.5%. It closed at the high of the day, and also with GDXJ was up 4.6%, very big volume, closed at the high of the day. And this comes, after the market made a low a week ago, and it's been trying to bottom. I mean, how can we not think that at least an interim bottom is in here?
Oh, I think today was a huge occurrence in the gold market. A couple things I've been looking for while this bottom has been playing out and things dropped further than I thought was number one, I was looking for a key reversal day. And we got that a few weeks ago, a day where the gold stocks are down 2-3%, they get sold out and they turn around and end up 2-3%. And the secondly was like when the after the initial bounce, you get a retest or decline, you have a day where, say, gold really begins to underperform the stocks, or the stocks begin to outperform gold. So, like, you get a day where gold, rallies 3 or 4%. Oh, sorry. So gold falls 3 or 4%, and then the stocks turn around and begin to rally. And today was fantastic because I got up this morning, probably like a lot of other gold investors, was pretty depressed, saw, gold down $30 in the futures market, stock indices down, people worried about Europe and the dollar rallying and all this sort of thing. So I saw that occurring, and then the gold stocks started down, and then all of a sudden I was just doing work and research on my newsletters, and then at midday I go, whoa, the HUI is actually up 5 points, and then it ended up actually up a couple percent. So, and even though gold still ended down about $7 on the cash, and even when gold was down $20 on the cash, the gold stocks are still up a couple percent. So I really like a day like today where these gold stocks have bucked kind of the market trend, and then the market's down, gold bullion's down, dollars up, everything negative that could be working against them happened, and they still turned around midday to finish the day extremely higher. I think finally that's a sign that we're just sold out.
And Dave, isn't that the kind of sign that we see at major bottoms in the precious metals complex? In other words, you typically see the shares lead the metals, and not just in one day as we saw today, but the shares have been stronger than the metals, I think, since last week. Of course, today really topped it off.
Yeah, and if you look at most of these gold bottoms, like the spring of 2004, or the spring of 2005, or like, again, the spring of 2006, even if the bottom takes a number of months to occur, what happens is there's an initial very good rally. Like, for example, even in 2004, 2005, even though the gold stocks retested the lows in 2005, there was a rally from the spring of 2005 into the end of 2005 that actually took the gold stocks almost back to their highs. And in 2006, same thing, even though later in 2006 the gold stocks retested their earlier lows, there was a rally that, again, almost took the gold stocks back to their 2006 highs before that retest. So we could be starting that very good knee-jerk kind of reaction rally, which could take us back up to, maybe 5, even 600 on the HUI before we pull back in the summer for a bit, and then really begin to move this year, early next year. So no, I think you're right. The fact that these stocks have finally begun to outperform the metal is a good sign. And again, if we take them compared to the metal, other than the financial crisis of 2008, they've never been this cheap compared to the metal in this entire secular bull market. So I think that will add to the rally because you're coming from such a depressed low point. Like, remember, like gold stocks compared to the price of gold in those 2004 and 2006 rallies were much more expensive. But now we're at like these kind of bear market low type valuations. So that should increase kind of the punch to gold's rally.
Yeah, that's a real interesting point you make there about how kind of the middle of that first leg, the valuations were much higher. And And of course now where valuations are, we're 11, 12 years into this bull market, valuations are sitting near a low, probably at a low except for the bottom in 2000. But what I want to get to, Dave, is I want to talk a little bit more about the cycles because something I've noticed in the last couple of days, the cyclical bear markets in gold stocks have all lasted about 18 months. The first one, you go back to the end of 2003, and of course 2004 into the middle of 2005, as you mentioned, that was about 18 months. Now, if you go back and, depending on which group of stocks you're looking at, you can either say it was early '08, but gold stocks, but most of the juniors in most stocks peaked, I think, kind of in the middle of 2007 or in April 2007. If you go from April 2007 down to October 2008, that's 18 months right there. You look at the large cap stocks, most of them peaked. Well, we did have that marginal peak last summer, but as far as time, you'd have to say there was a major peak at the end of 2010. Where are we now? We're in May 2012, so roughly about 18 months of time, and the gold stocks have certainly struggled from that point. And at the same time, you look at all of the bull cycles have been about 2.5 to 3 years. So is that? Can we expect? Whether the bottom is here or if we retest it again in a couple months, can we expect a cyclical bull to be 2 to 3 years from that point?
Yeah, not only that, I feel that there's some kind of 4-year cycle that has now been created in the gold stocks during this secular bull market. That there's something called the 4-year presidential cycle, where people talk about most times since about 1960, almost every time the second year of the presidency, which is roughly 66, 70, 74, 78, etc., there was a good intermediate to major bottom in the stock market. And other than a couple periods in there, most of the time that really, really, was the case. And I think since 2000, if you look at the fourth quarter of 2000 low, the low in the gold stocks, then 2004, then 2008, now this year, there seems to be a 4-year cycle to what you're talking about, that you get about a 2 to 2.5 year up cycle followed by a 1.5 year long retracement, which ends up being 4 years. So there seems to be like a 4-year bottom in the gold stocks, and I think that's what we're going to see. Like you said, even if it's now or if it's during a retest this summer or fall, we're going to see that kind of bottom play out here in the gold and precious metal stocks. And I think the one thing that makes this so unique is where the precious metal prices are. It's that even if you couldn't move from here, silver at 26.27, gold at 15.50, these are prices where these companies can make money and have new finds and all this sort of thing. So the interesting thing about where we are today is a lot of these indices, going from the junior indices to the senior indices like the HUI, there's no reason these stocks can't double in price and still be at fair value compared to present day precious metal prices. So it's really difficult to get bearish down at these levels. And like one of my arguments, and fundamentally what I think is going to happen, forget all these technicals of the 4-year cycles, and you're talking about the rallies and how long they are, is that I really believe that within the next 3 to 4 to 6 months, Greece is going to default and possibly leave the euro. And that will start a new round of money printing in Europe to buy the debt of some of these other big countries, or even buy maybe euro bonds if they begin issuing those. And then money printing in the United States is they're going to have to buy their own debt probably after the election. So this kind of Greece default will be the inflection point, and it's kind of like after Lehman Brothers, where the gold stocks fell hardest going into the fall of 2008. Then they bottomed first, and then they were one of the best performing sectors coming out of that bottom. So that's kind of what I see here, that they've fallen the hardest now, that when this Greece default might come, if I'm right, I don't think the gold stocks will be near those lows of a few weeks ago. I think the gold stocks will be like 2009. They'll be, when the market made a new low in March 2009, the gold stocks were way above their November 2008 lows in March of 2009. So in a few months, the gold stocks will be higher than the lows, even if the equity markets are making new lows, and we'll turn around and get ready for a very good kind of 2 to 3 year rally in the gold stocks. So what I'm trying to say is these cycles and these kind of cyclical theories fit in with what I see as the big macro theory.
Right. And getting back to the equities, we know that this is a very difficult industry. So even if the fundamentals are really bullish for, gold producers and explorers, there's still a lot of companies that just they have their struggles and their difficulties because that's just the nature of the business. So that being said, I mean, the way these things really rebound off these 4-year lows, I mean, you see some major significant moves in terms of percentages. And I mean, looking at the indices, and that's when you look at those moves, you have a lot of stocks that perform even much better than that. And of course you have some stocks that perform worse than that. I mean, you look at the HUI; it went from a low of 150 to over 600. I mean, that's more than a fourfold gain, which is fantastic. But I put out a update to subscribers earlier today, and I was looking at how well certain stocks performed coming off the 0405 low, and then the 2008 low. I mean, you can buy a lot of producing companies with projects in the pipeline from which they can grow production. I mean, you can pick good companies that have the ability to grow. And Dave, I mean, those companies that operate well, they can see significant percentage moves. I mean, we're not just talking about doubling or tripling your money. I mean, these things have gone up 5 or 10 times in these cyclical bull markets. I guess that's something that I'm
Yeah,
focused on. I mean, what are your
I
thoughts on
would
that?
I would agree with it. I think these kind of smaller producers that are expanding for whatever reason that have been whacked during this, move downwards, or companies with large resources that are expanding those resources, those are probably what you want to be in right now. The thing is about it's like a trickle down effect in the gold market that, and you saw this kind of in the junior market in 2008, 2009, that, really you wanted to be in the seniors or producers or even small producers for the first, say, the bottom in November 2008, until about mid 2009, that first 6 to 9 month period. I would think it's going to be the same way now that a lot of these pure junior companies, they're going to run into tax law selling probably at the end of the year again this year, and they'll probably lag for the next, 3 to 6 months. So you want to be, like you just said, in those new producing companies that have a chance to expand production, or large exploration companies, which are just or mid-sized exploration companies that have 43-101 resource and can expand that resource. Like being in more of the pure junior plays, I don't know about that right now. You probably still have till the end of the year, even early next year, to really enter a lot of those plays at pretty good prices because they're going to have a lot of overhang and they're more liquid. So, no, I agree with you. I think you look at like a lot of the companies that were coming online with production, they got beaten up in the financial crisis. A lot of them were the 10, 20, 30 baggers of 2009 to 2011. And I think you have to kind of look at that here, where a lot of these companies can be, you know, like that going forward from, say, 2012 to 2014 or 15.
Right. Yeah, I agree with you on the exploration juniors. I think it's going to take a little bit of time before they recover. So I would just be wary of a lot of the people in our industry who are touting those. I mean, I know they're very cheap, but they're cheap for a reason, and that's because costs have been going up, and
And the one thing, and I plan on removing some of these companies after maybe a little bit of initial bounce, because you have to be realistic about it. After '08, a lot of juniors did not come back. Like maybe they went from, let's just use an example. They were like $1.50 or $2 junior, and they went down to 10 or 20 cents in the financial crisis. They went back to 40 or 50 cents because they have to issue shares and dilute to raise money to survive. And you have a lot of overhang. And like I said, they're not liquid. So that overhang is very difficult for them to work through. So the same thing this time around, like juniors, unless they become like a major producing company, have a much shorter shelf life where, probably a lot of these mid-tier and large cap stocks you can own for the next 5 or 10 years during the secular bull market. You can't do that with a lot of these juniors. You're going to probably only owe them for a year or two during the next rally in the secular bull market. So I just think you have to be aware of that too. Like I know I have a couple stocks that have done poorly, a couple juniors, which I own, and I just know that they're probably not going to bounce as hard. So I'm going to be looking to actually just, kind of lick my wounds, take my losses in those, and then go into stuff that I think can really, really, do well. And I've added a couple of those type of companies to my list recently, and we'll probably add more in the coming months. And I think personally, right now, my game plan is I'm taking the total John Templeton maximum pessimism kind of outlook that I want to be in the sectors that are the hardest hit right now. Like for example, I've done a couple of reports on actually buying certain things in Greece because that's the center of the storm, and those will have the biggest, I think, rebound rally right now. And then also the precious metals, I think, are the other sector, and it's similar to the financial crisis, where at that time it was anything financially related, anything with high debt was the hardest hit, and you wanted to go in and buy those companies or you wanted to buy gold and precious metals. So I think it's similar to that. That's the makeup right now, that I want to buy stuff in the center of the storm and the precious metals because for whatever reason they have really, really been hit the hardest. And the last note on this, and this again is a fundamental standpoint, I think this Facebook bit of a disaster with the IPO is really, again, going to help the precious metal sector in the next year or two as part of this bull market we're talking about, because probably one of the few equity bubbles left, or mini bubbles, or overheated markets, whatever you want to call it, has been these social media kind of websites. And because gold is so disliked by the mainstream media, that they will look to anything that's going up instead of gold. And this is kind of being the final technology type bubble. And now I think it will burst in the next year, can lead to assets going into the gold market, bull market.
Yeah, I think that's a great point. On that note, Dave, we have to end it here, but thanks so much for your time and your great insight as always.
Oh, thanks for having me.